Good morning. Curtis Chandler here, President of PFL, bringing you last week's North American rail, energy, and macro update. Let's break down what is driving the conversation. Markets finished the week in the green despite softer employment data. The Dow added 587 points last week, the S&P gained 151 points, and the Nasdaq surged nearly 800 points. Jobless claims rose 226,000, up 7,000 week over week, and continuing claims climbed to almost 2 million. Even with the labor market showing some cracks, equity momentum held firm. Oil was mixed last week. WTI closed on Friday at $63.88 per barrel. That was down $3.45 per barrel week over week. Brent was slightly higher on Friday, but still posted weekly losses. U.S. commercial crude inventories fell by 3 million barrels and are now 6% below the 5-year average for this time of year. Gasoline and distillates both drew down, while propane inventories climbed to 8% above the 5-year average for this time of year. Propane prices closed at 72 cents per gallon, which was up 3 cents per gallon week over week. North American rail volumes nudged higher. Total carloads were up by 0.74%, while intermodal was down by 0.35%. 6 of 11 of AR's major traffic categories posted declines, with the steepest drop coming from metallic ores, which was down 10%. Grain was up 22% and was a standout. The 4-week rolling average for petroleum rail cars rose to 28,164, up 382 rail cars week over week. Here's what we are watching out there for you. We are watching major M&A activity. FTAI Infrastructure is spending $1 billion to buy the Wheeling and Lake Erie, with more than 1,000 miles of track connecting 3 regional class ones, and backed by $2.25 billion in new funding. This deal could offer shippers more flexibility and better routing if integrated well. We are watching tariffs. The July import surge has ended. Containerized cargoes to the U.S. ports is now projected to drop 5.6% year over year, with August imports down 10 to 15%. September is projected to be down 20%. This means fewer intermodal moves and possible service cuts in key corridors. We are watching wildfires. Over 6.5 million hectares have been burned in Canada this season, more than double the average. Fires have forced shutdowns and reroutes, hitting the CN in Manitoba, Alberta, and BC, and disrupting intermodal flows through Vancouver. We are watching continued regulation. Canada has stepped up enforcement under the Railroad Safety Act and tightened emissions oversight, while in the U.S., the proposed Railroad Safety Act of 2025 brings sharper hazmat inspection rules. Compliance costs on both sides of the border are set to climb. We are watching fuel by rail. Canadian crude by rail exports continue to slump, failing to be economic versus pipeline. NGL and ethanol shipments are up, boosted by new export capacity. However, expect a slowdown in ethanol exports to Canada as Canada retaliates. We are watching the rail equipment market. Leasing remains firm, especially for pressurized tank cars, while the new build market softens as buyers defer orders. The mandated phase out of 111s and CPC's 1232 cars by 2029 continues for the need for newer equipment. Big picture, shippers and operators who can adapt more flexibility in their networks will be best positioned for the volatility ahead. For the latest updates on equipment for sale or lease or customized rail solutions, contact Us here at PFL, remember, we clean, flare, service, and store rail cars across North America. I'm Curtis Chandler. Thanks for listening. Stay prepared, stay positive, and take what comes one day at a time. Please read today's report. We do it all for you. Hope you have a great day. Thank you.